Today's financial markets are witnessing an unprecedented event that has captured the attention of investors, policymakers, and everyday people alike. Silver, a precious metal that for centuries has been valued both as a store of wealth and a vital industrial commodity, has surged to record-breaking price levels. Prices that were once considered extreme have now become reality, pushing silver to heights few analysts forecasted more than a year ago. This rally is not confined to one exchange or one region. Across global markets, from New York to London and right through to Shanghai, silver prices have been climbing relentlessly, setting new all-time highs. International spot silver has recently crossed the $75 per ounce mark, with some markets reporting prices above $77, levels never seen before in the modern metric of precious metals trading. This extraordinary price action reflects a combination of deep structural shifts in the global economy, changes in monetary policy expectations, and evolving investor psychology. The story behind this rally is complex, and the implications are profound. In this video, we will explore what has driven silver to these record highs, why China has emerged at the center of the narrative, and why there are growing concerns that this price boom could herald trouble ahead for markets and the broader economy. To understand the significance of the recent silver surge, it helps to look first at the metal's dual identity. Silver is a precious metal like gold, cherished as a store of value in uncertain times, yet at the same time it is an industrial metal essential to modern technology. From solar panels to electric vehicles, consumer electronics to medical devices, silver's unique properties make it indispensable in a host of high-growth sectors. This dual role means that silver's price is influenced by both financial investment demand and real industrial consumption. When markets are calm and economic growth is steady, industrial demand tends to dominate price movements. When fear grips global markets, investors turn to precious metals as safe havens, pushing prices higher. In the past year, both of these forces have converged in a way rarely seen before. One of the primary drivers behind silver's dramatic rise has been the expectation of lower interest rates, particularly in the United States. The Federal Reserve, which for years maintained tight monetary policy to combat inflation, has shifted toward a more dovish stance. After cutting interest rates multiple times, traders are increasingly betting on further reductions in 2026. Lower interest rates reduce the opportunity cost of holding non-yielding assets like silver and gold, making them more attractive relative to bonds and other income-producing securities. They also tend to weaken the US dollar, and since precious metals are priced in dollars, a weaker dollar makes silver cheaper for holders of other currencies, driving up demand. This has helped fuel a broad rally in the precious metal space. Data from the past months show that real yields on US government debt have declined, and the dollar index has fallen sharply, reflecting a shift in investor sentiment and expectations around future monetary policy. As the dollar weakened, silver's appeal as a store of value increased, leading to sustained buying pressure across markets. This interplay between expectations of rate cuts and currency movements has thus been a central theme in the metal's run to record highs. These dynamics are not isolated to silver alone, but silver's smaller market size relative to gold amplifies price movements and volatility. Another major factor contributing to silver's price surge is persistent supply constraints. Unlike gold, which is primarily mined and held for investment, silver's supply chain is tied closely to industrial mining of other metals. Many silver producers extract silver as a byproduct of mining for lead, zinc, and copper. When production of these base metals slows, as it has in recent years due to various logistical and economic pressures, silver output declines with them. At the same time, inventories of physical silver held in exchanges and warehouses have been shrinking. In China, inventories have fallen to multi-year lows, driven by strong domestic demand and increased exports. Data from trade figures show that exports of physical silver have reached record levels, draining stocks that would otherwise cushion market supply. This tightening of available supply has created a situation where demand often outpaces the ability of the market to deliver physical metal, pushing prices higher. China's role in this story is particularly notable. As one of the world's largest producers and consumers of silver, changes in China's markets can reverberate globally. In recent months, Chinese investors have shown intense interest in silver as an asset class, both for investment and industrial use. The demand has been so strong that specialized silver investment funds in China experienced extreme volatility. Huan Sakfunde, which had been at the center of a speculative rally, saw its value plunge by the maximum daily limit after warnings from fund managers about unsustainable valuations. This sharp drop revealed the precarious nature of speculative positions built on thin margins and highlighted how quickly sentiment can reverse when confidence falters. At the same time, premiums on silver traded in Shanghai have reached historic levels, indicating that physical silver is in high demand relative to available supply. This phenomenon, often referred to as a Shanghai premium, shows that buyers in China are willing to pay more than global benchmark prices to secure metal locally, a clear signal of strong domestic demand. While investor enthusiasm and supply constraints have fueled the rally, geopolitical tensions have also played a significant role. Over the past year, tension between major global powers, especially between the United States and China, has increased uncertainty in financial markets. Trade disputes, sanctions, and broader geopolitical frictions have heightened risk aversion among investors. In such an environment, traditional safe haven assets like gold and silver become more attractive. Historical precedents show that during periods of geopolitical instability, demand for precious metals often rises as investors seek to protect their capital against market volatility, currency devaluation, or systemic shocks. As geopolitical headlines have drawn attention to potential disruptions in trade and capital flows, investment allocations to precious metals have increased accordingly. At the same time, global economic growth has been uneven. While some economies show resilience, others exhibit signs of slowing momentum. Economic data suggesting slower growth in major economies like the US has reinforced the narrative that central banks will continue easing monetary policy, further supporting precious metal prices. Combine this with persistent concerns about global debt levels and currency stability, and the appeal of silver as an alternative store of value becomes even stronger, despite these bullish forces. There are growing warnings among economists and market strategists about the risks of this rally. One major concern is the speculative nature of price movements. When an asset's price raises rapidly in a short period, especially one with a relatively small and tightly traded market like silver, it can create an environment ripe for bubbles. Bubbles are characterized by prices detached from underlying fundamentals and driven instead by investor psychology and momentum trading. At record price levels, silver's valuation may already reflect not only supply and demand realities, but also inflated expectations about future price gains. If investor sentiment shifts or if monetary policy expectations change unexpectedly, the sharp gains could reverse quickly. Another source of concern is the potential for market illiquidity and increased volatility. Silver markets are smaller than those for gold or oil, and they are more susceptible to sharp price swings when large amounts of capital move in or out of positions. During times of heightened volatility, sudden sell-offs can trigger margin calls, forcing leveraged traders to liquidate positions rapidly, which in turn drives prices down further. The recent plunge in the value of a major silver fund in China underscores how quickly markets can turn when leveraged positions unwind. There are also broader economic implications to consider. While high commodity prices can benefit producers in mining economies, excessively high prices for metals like silver can have negative impacts on industries that depend on them. Silver's extensive use in solar panels and electronics means that sustained high prices could raise production costs for companies in renewable energy and technology sectors. These sectors are integral to long-term economic growth and the global transition toward cleaner energy sources. If silver prices remain elevated, the cost of deploying solar power infrastructure and high-tech products could rise, potentially slowing adoption rates or pushing manufacturers to seek alternative materials. This kind of industrial strain could have knock-on effects on employment, technological investment, and broader economic performance. Moreover, high precious metal prices often coincide with inflationary pressures in the broader economy. While some inflation can be a sign of healthy demand, inflation that outpaces wage growth and productivity gains can erode purchasing power and contribute to social and economic stress. Central banks walking the fine line between supporting growth and managing inflation must consider how asset prices like silver affect consumer expectations, business investment, and financial stability. If precious metal rallies continue unchecked, they may influence central bank decisions in ways that could have unintended economic consequences. China's economic trajectory adds another layer of complexity to this unfolding story. as the world's second-largest economy. China's financial markets and commodity consumption patterns have a significant influence on global prices. China's efforts to secure natural resources and stabilize its currency have led to increased demand for precious metals, both as reserves and financial assets. However, China's markets have also experienced bouts of regulatory intervention aimed at cooling overheated segments and protecting retail investors. How Chinese regulators manage speculative activity in silver could determine not only domestic market stability, but also have ripple effects worldwide. Looking ahead, there are questions about sustainability. Will silver continue to climb to ever higher price levels? Or has the market already reached a peak driven by short-term speculation and technical trading dynamics? Some analysts argue that prices could push toward new milestones, with projections of silver reaching prices near $90 per ounce if current trends persist. Others caution that such forecasts underestimate the risk of market corrections and the reality that prices driven by sentiment rather than fundamentals are inherently unstable. For individual investors and retirees who hold silver in physical form or through exchange-traded products, these developments present both opportunities and risks. On one hand, record high prices mean substantial gains for those who entered the market early or held through volatility. On the other hand, the risk of dramatic reversals means that timing and risk management are more critical than ever. Diversification remains a key strategy for investors. Looking to balance exposure to precious metals with other asset classes, institutional investors and policymakers are also paying close attention. Central banks have been notable buyers of gold in recent years, and some have increased their allocations to silver as part of broader reserve diversification strategies. These actions reflect a long-term view of precious metals as a hedge against currency risk and systemic uncertainty. However, central banks typically move with caution and overextended time horizons, and sudden changes in monetary policy expectations could influence their appetite for expanding precious metal holdings. In financial markets, silver's performance is often measured against gold's. Historically, the gold-to-silver ratio has provided insight into relative valuations between the two metals. When this ratio narrows, it suggests silver is gaining value relative to gold. When it widens, silver is lagging. In recent months, this ratio has tightened significantly, reflecting silver's strength and signaling to traders that silver may be entering a unique phase of market revaluation. Whether this trend continues or reverses will depend on a complex interplay of macroeconomic data, monetary policy decisions, geopolitical events, and shifts in industrial demand. Another important factor is technological innovation. Silver's role in emerging technologies, particularly renewable energy and electronics, continues to grow. Industries such as photovoltaics, solar cells require silver in critical components, and demand from these sectors could remain robust even as prices rise. However, technological adaptation can also impact demand elasticity. If silver prices remain high for prolonged periods, manufacturers may accelerate research into reduced silver usage or alternative materials, potentially dampening long-term demand. This paradox highlights the tension between silver's indispensable role in modern technology and the economic realities of pricing and cost efficiency. In conclusion, the record-setting rise in silver prices reflects a confluence of forces shaping global markets in ways that few investors have seen before. Monetary policy expectations, supply constraints, geopolitical tensions, industrial demand, and shifting investor behavior have combined to push silver to levels that challenge historical norms. China's central role in this story underscores the interconnectedness of global markets and the influence that major economies have on commodity prices. Yet, beneath the surface of this dramatic rally lies significant risks and potential trouble ahead. Speculative excesses, market illiquidity, industrial cost pressures, inflationary dynamics, and broader economic uncertainty all raise questions about whether current price levels are sustainable for investors, policymakers, and everyday citizens who follow financial markets. These developments offer both opportunity and caution. Understanding the full implications of this surge requires watching not just silver prices, but interest rates, geopolitical developments, supply chain dynamics, and technological trends that will shape the future of global markets for years to come.